Welcome to Real Estate Investing Open Kimono by Home365. I'm Daniel Shaked, and here we are exposing real estate's biggest traps with brutal honesty, no fluff, just raw truth to help you win. Let's dive in. Joining us today is Yair Benyamini, co-founder and CEO of Lendai. Yair started his career as one of the Israeli's top law firms, building expertise in international law and business development. After leading large-scale operations across multiple industries, he set out to tackle one of the biggest challenges in real estate, helping foreign investors to break into U.S. market. Today, through Lendai's technology, he is making process faster, simpler, and more accessible than ever before. Yair, man, I'm so happy to have you here. It's a pleasure. We are friends for a long time and buddies to that challenging industry. Good to have you here.
Likewise, first of all, thank you for having me, and it's always a pleasure to have some time to talk. And as you said, open the kimono, speak the real truth of the industry, the things that sometimes they don't tell you on the Instagram, on the all those fluffy posts online. And it's always a pleasure to speak with you as a friend and as a colleague.
That's amazing, for sure. All those influencers you mentioned, Instagram, filming themselves. Hey, this is the house I bought. How do I scale it from 1 to 100? Let me teach you. I mean, all that thing has so much nuance to it. And it probably was, they're talking about previous times in the market, which are completely different maybe now. And this is what we are going to scratch a little bit and talk about. So tell us about Lendai first. Seems like a super exciting company and venture. I'm really eager to learn more.
So Lendai, we established a company over 6 years ago. I was still based outside of the US at the time. We were investing into the US. And we found ourselves tackling into a big problem when we ran out of our own equity. So we said, okay, what do we do in real estate when you don't have enough equity? You go to a bank. So we went into a bank in the US. I won't name names of the
No,
banks.
no, give us the names. Give us the names.
No, it's
No,
okay.
no, okay.
It's all of them the same. So it doesn't matter who I name here.
You're right.
And I said, okay, I want to buy another property here in the city. We already have a few of them, but we're down by all cash. Where do we sign on the mortgage? The US banker simply looked at us, smiled, and said, well, we know the properties here just fine. We know how to evaluate them, how to put a lien on them, how to foreclose them. We know everything we need to know about US real estate. The only problem is you. You have no residency here, no US citizenship, no credit score. We don't really know who you are. So thank you, but no thanks. You won't see a dollar from us. When we went back to our bank in Tel Aviv, in Israel, we asked the same question, and we got the exact opposite answer. They told, well, we know you just fine. You have great salary, many years kind of this bank. We do a lot of things with you here in Israel. We'd love to work with you here in Israel, but you want to buy a property in another country? We don't know how much it's worth. We don't know how to put a mortgage on it. If you don't pay us, how do we foreclose something in the US? So thank you, but no thanks. You won't see a dollar from us. And with this encounter with the traditional banking system, it just didn't make sense to me. It said, how could it be that a good investor from overseas, someone that have enough money in their country of origin to go and diversify into the US market, and a good investment property in the US, we're buying cash flow investment properties, and the regular banking system simply say no because of this operational and information gap in the market. So we decided to build Lendai as a platform that allows foreign investors from all over the world to invest in US real estate like locals. And the first thing we choose to tackle is, of course, the financing, because that was the main problem that we found. You're stuck and you're limited by your own equity. So we built an underwriting system that basically looks on both sides. It looks on the US property, analyze the property income, the property value, the market rent, everything related to the risk related to this property in the US. But on the other side, we built another system looking on the investors in their country of origin. So I'm looking on the Canadian, Canada, the Brazilian in Brazil, the Australian, Australia, or the Israeli in Israel, and asking, is this a borrower that I want to lend money to based on his income, based on his assets, based on his history in his country of origin, not correlated to the properties maybe he's buying
How do
tomorrow.
you know about their history in their countries of origin, like Brazil? I mean, for me, it's
So
like,
you'd be surprised to know, but most countries, especially all Western countries, there's a lot of other, Brazil, for example, Mexico, they have very good systems in place. They already have credit scoring in their own. It's a different credit run than the US, but they have a credit system. They have banking information, and some of them already have open banking. So the data is there. It's not structured the same as it is in the US. So you need to understand how to ask the questions and how to understand it. I'll give you an example that I always like to give about Australia. Two things about Australia when we entered the Australian market. So when we started, we saw that a lot of very high net individuals, bankers, lawyers, and when you ask them, do you have a credit card? They said, no, I have only a debit card. Think about it in the US, it's someone with no credit card, he's for sure not a credit worthy. But the guy has $2 million in his bank account. And then you understand it's a cultural thing. In Australia, credit cards are not as common in the US. People are using debit cards. So just the fact they have a credit card, not a credit card, it's not a limiting factor because you need to understand the culture. Another thing, when we're looking on job stability. So I don't know if you know, try to guess what is the most stable job in Australia.
Most stable job in Australia, a doctor.
So the most stable job in Australia is a truck driver. So why is that? Because Australia is
Makes
built
sense.
on the coastlines. Everything needs to be moved across the country. So the most stable job in Australia is a truck driver. So they make a lot of money and they're very stable jobs. Looking on a truck driver in the US, as you said, maybe I want to see a doctor as well. But I said if the client has no credit card, he has a debit, and he's a truck driver in Australia, that could be an amazing client for you. But maybe in the US, you would look at him, he has just a debit card and he's a truck driver and not a doctor. Maybe I don't want to lend you. So you need to adapt the model. So you build a main model and then you adapt to the different countries and you combine all the data into one decision-making mechanism that tells you is this property and this borrower is who you want to lend to.
That sounds complicated, man. I'm so curious to know how you cracked this entire thing and how you incorporate everything into like one platform. The underwriting seems like a very tough thing to do.
It is once you understand how to mitigate the risk and how to connect all the dots, it's again, we have zero default rates across the entire board of loans of hundreds of millions of dollars that went through our platform. Because again, those are good people with good properties. The only crime they have is that they're not living in the same country as their property. That's it.
So let me ask you a question. Like international, you are mainly aiming at international investors. Do you
Yeah,
work
today,
with like Americans as well, or
yeah,
mainly
around
international?
today it's 70-30. 30% of our revenues come from locals because either newcomers to the US, green card holders, visa holders, or straightforward Americans that live and invest here in the US. And 70% is strictly foreign people that live outside of the US. Some of them never even visited into the US, but they're still buying here real estate.
So if I'm an investor living elsewhere in the world, China, Japan, you mentioned Australia, what in my perception, in my mind, is so appealing about the American market, about the US market, comparing to what I know from my kind of local ecosystem?
So it's a good question. And let's say you chose randomly, you chose Japan. So let's look on
Japan.
Japan. So when you're looking on real estate in Japan, the entry point to the market is much, much higher than the US. In the US, you have, again, depends where, you can buy sometimes property even less than $100,000. I'm not saying that I'm
You
recommending
will not
anybody.
underwrite this property.
Yeah, but let's say $100,000, 150, you can buy great properties in some locations in the US. You have nothing like that in Japan. Properties are much more expensive. On the other side, on returns, like the Canadian likes to call the US market, US investing, half the price, double the return. So the market in the US is lower as far as entry point markets, and the returns are much higher.
So
Add
the
to
cap
that,
rate, basically.
exactly. So it's a higher IRR. And add to that the fact that the US is the largest economy in the world. The US real estate market is the largest real estate market in the world. There's a lot of transparency. There's already a lot of data. There's more data in US real estate market than any other country across the world. So you can access the data and take smarter decisions. And everything is in English and everything is according to the law. We know some people are investing
Regulated.
not just regulated, even just reading things. So you invest in Spain or you invest in Portugal. If you're not speaking those languages, you don't even understand the legal documents. But it's very easy to people to understand a legal document that is written in English because that's the global language. So that's one. And on top of that, again, now we're in a bit of a shift in markets, but you're investing in US dollars. Again, a very safe currency that you know how to buy it, you know how to sell it. It's very, very tradable. So all those things together, the accessibility as far as the values of the property, the flexibility as far as different methods to invest, and the language that there's no language barrier with the US, all that together comes to a very appealing market from investors from all over the world.
So you started 6 years ago, and do you want like can you share any like, volumes or which are the most active countries that you service? Anything, anything.
Yeah. So today we operate in 43 states across the US.
44.
Yeah, across the US. Basically every relevant state, the niche small markets. North Carolina is amazing, but North Dakota, nobody's buying there. So we want to be licensed and operate in the places where investors are buying. We have clients from over 30 different countries. The big ones, of course, is Canadians are the largest buyers of real estate in the U.S., mainly in the Sun Belt, so Florida, Texas, Arizona. That's where the Canadians want to buy sun, as they say, and the snowbirds want to buy a second home or in those places. Europeans are, again, also a lot of Florida. We have Latin Americans buying, if we're looking on Mexicans, a lot of Texas, close to them, easy access for them. Colombians buys a lot of Florida. The main markets that we see is Florida and Texas. And then it's California and all the rest, basically spread pretty evenly across the rest of the markets. And as far as Latin America, so again, go to the economy, the biggest economy, that's where the market will come. So we have Argentina, Brazil, Colombia, Mexico. Those are the big markets that buy US.
A lot of money coming from the South American countries, basically.
A lot of money. In general, again, talking about the US as a good place to do business. One of the things, if you want to predict where will be the next market of investors from all over the world, just look on geopolitics. Where you see a country that has internal problems, we can take Israel. When Israel had a war in Israel and a judicial reform in Israel, people that have money say, okay, I'm safe here. What do I do with it? And the safe haven is always US, and it's always US real estate. Same goes with Argentina, same goes with Colombia, same goes with any other country. If you look at what happened, if a country has internal problems, the people that have money will push the money outside of the country into the US and usually into the real estate market.
So how's the process starting? Let's say I'm a Colombian, or let's say I live in Argentina or something. The macroeconomy and the entire environment is not stable. By the way, Argentina is super stable now, or much more stable than it used to be.
We're rooting for them, and actually with Argentina, we're doing something similar, different. So a lot of Argentinians along the last 10, 15 years bought real estate in cash in the US, mainly in Florida, but not just.
So you refinance.
Exactly. So now they say, now the market in Argentina is better, so I want to cash out my property in Florida. I bought $1 million property 5 years ago. I want to extract $500,000, $700,000. I'm going to take this money back to Argentina, and now it's time for me to buy back in Argentina because the market is more stable and I can afford more things to buy there. So we see both sides. When market is better, sometimes the money goes out.
Okay, makes sense. Makes sense. So let's say, how do you start? If I'm like a new real estate investor, never experienced investing in U.S. market, and I want to start, of course, I'll get probably a realtor. I'll start researching some of the market. How do I find you? Like, how the process looks like right now?
So first of all, as you said, the first step to do is start educating yourself. Is listening to podcasts like this and any other educational videos and books that you can read. Start understanding the market because the U.S. real estate is huge. Once you understand more or less what's the strategy that you're going to, you need to find usually the boots on the ground. So as you said, the realtor, the property manager, the developer, maybe if you're building a new house or you want to do a fix and flips, or the GC, you need to start creating this team. Lendai is basically part of this team because what you can do with your capital is limited. What you can do with our capital is 3x and sometimes even 4x more than what you just have from home. So once you understand what you want to do, you basically reach out to your realtor, property manager, developer, any one of those different service providers. They work with us. So Lendai is built as a B2B2C. So 85% of our clients come to us through our partnership network. So they go to Home 365 and say, hey, I want to buy a property. I want you to manage this property. I have $200,000 and I think I want to buy 2 properties. Or I want to buy a property in $600,000. They can click on a button in the platform where connected to the realtor, the property manager, etc., connect them to us, get a term sheet the same day, or we ask a few questions, understand the deal, we price it same day, sometimes even same hour. They get all from our side, and then they look on all the numbers. Say, okay, this is the purchase price. This is how much it's going to cost me to manage this or to renovate it. This is how much the financing will cost, and here are all the closing costs. Now, is this a good investment to do? If the answer is yes, they pull the trigger, put it under contract. We basically work simultaneously, if we're talking about a purchase loan, with the realtor and with the borrower along the 30 days that they have to close, for example. Along this time, we order the appraisal, we order the background checks, everything related to the borrower. We value the entire deal. and we make sure that we're ready in time for closing, for the complete the underwriting. Everything is fully online, so they get access to the platform. They request the loan in the platform, get a term sheet, approve the term sheet, upload the relevant documents that they need, or sign on the application. Everything is online. We do all the heavy lifting of every third-party reports, insurance, taxes, everything that is needed to be done as part of the loan. Once everything is ready, we give here's based on all the information that we've learned during this underwriting. Here's your final offer. Sometimes it's better, sometimes it's worse. Depends on the status of the market, and they think that the property is worth $200,000 and it's worth 180, so maybe we'll adjust it. But sometimes it will even be worth 220. So it depends on them, and maybe we can offer them more financing. Okay. And then they sign on the documents. The entire loan closing is also an online closing wherever the country of origin allows it and the state allows it. So places like Georgia, for example, you cannot do remote closings, but in Florida, they don't even need to go out of home. So they go on the computer, get on a Zoom call with a notary, US notary, sign on everything, and the next day the money's in their bank account.
Wait a second, I want to double click on that. So you're saying you can do the entire process online. We are also an online company and we're trying to automate everything around property management to replace the human property manager as we know him. And you just mentioned that in Georgia, you said you can't do the process fully online.
Yeah, so basically,
it's a regulation on the fintech side, or what is that?
It's not on the fintech side. There's a few states that I don't know why, but they still are not allowing a remote notary to notarize documents. So there's Georgia, and I think New York is one of them. Alabama, I think, is another one. There's like 4 or 5 states that's still not there yet, even though during COVID they allowed some things, and when COVID wound up, they went back. And so we can do everything online, but they're not allowing an online notary. So you have to go to either an embassy or a notary in your country of origin, with a notary and apostille. We will facilitate the process. We'll send you the notary. We'll do everything. But again, where law allows it, we'll do it remotely. When it's not, we'll do it regular.
The real estate industry should adapt itself to the ongoing evolution of technology. A lot of the regulation is super old and it's not in favor of innovation. I see that across different states as well in property management. But now I hear about online notaries, which I thought is something that's straightforward already everywhere.
No, it's again, I don't know exactly the facts. A lot of people are talking about eventually you need to follow the money, like in everything. If someone today is making money from physical notaries, he will fight against moving into online notaries, because then you can take a notary from Virginia and sign on your documents in Georgia. Today you have to have a Georgia notary or something like that if you want to sign a Georgia notary document. So there's always money involved in those kind of things.
At a certain point, I'll do a piece about the regulations. We are meeting those requirements or regulation hardships all over the place, all over the states, with different aspects of our business. And so it becomes like a major issue for us as well. I'm happy to see that I'm not the only one, having challenges there. Let's put it aside at this point. It's our problem, not our listeners' problem. So if I'm that person in abroad and I did the entire process with you, what would be usually the down payment I'm required? Like, how much will you finance usually? Is that like the 80%? The
more? So again, talking widely on, because there's a very product. There's fix and flip and construction, and they're 30-year based on their income or based on the
investment, let's say.
So usually what a foreign national will get from us will be around 5% less than what an American. So if an American can get 80% financing on a purchase, a foreign national can get 75. On a cash out refinance, an American gets 75, so a foreign national will get 70. That's usually where it stands, even though, again, there's always caveats. So if we're talking about a fix and flip or a ground up construction, if the borrower has a lot of experience already in the US, I will treat him as a local. So we're doing now, for example, a loan for investors from overseas that already done over 10 houses that they built in Florida, and we're financing the next 10 ones. So we're giving them 90% loan to 70. So we're treating them the same as Americans, because if they already successfully completed so many projects, so there's no, even if they're doing it remotely, they actually build a system that works for them. So we can count on them and leverage them more.
Got it. Got it. And what would the APR be like more expensive for internationals than locals, or more or less the same?
You can, foreign national usually, again, I'm generalizing here,
Generalizing. Yeah.
they will get the pricing as an American with somewhere between 680 to 700 credit score. So if you're an American with a 800 credit score, you'll probably get a better pricing. But if you're an American with 680, you'll probably get the same as a foreign national. If you're and one of the best thing is, if you're a foreign national, we don't really need you to have any credit score. So maybe we run your credit and it comes up empty, it's fine by us. Or even if it's count very low because you don't have any history in the US, we can ignore it. So again, compared to a decent American that has decent scoring, that's pretty much where the pricing is.
That's surprising to hear. Okay, cool. Sounds good. Sounds great. Okay, walk me through the how you underwrite not the person and his ability to pay your mortgage and the loan, but the quality of the property and the ongoing kind of future hardships. This is where we play basically as property managers. How do you know what's the quality of the management gonna be? How do you know what's the delinquency, potential delinquency rates in this specific area? Like, how do you think about the property side and the ongoing holding period going forward?
Yeah, so if
From
we're
the
talking
perspective
about,
of ability to serve the loan, basically.
exactly. So if we're talking about long-term rentals, loans for 30 years based on the income of the property, it depends on the type of program. For example, one of our program requires either a property, they have a US based property manager, or they have experience of over 2 years documented experience of managing properties, so they can show us that they actually can do it, and they have their own team. Sometimes they're big enough, sometimes they have their own teams. And then we look into the property management as well, where we'll ask, again, depends on the product, but we'll ask how many properties do they manage. Let us see the website. If we already know them and work with them like Home 365, so no problem. But if it's a new property management, we've never heard of it, we will do on the back end, we'll do some underwriting to see that it's a real company. They actually manage enough homes. That tomorrow morning the investor is not buying something. He's sure that he has an amazing property manager, and he's not even collecting the rent. And if he's not collecting the rent, so the investor has problems on paying the mortgage. So that's one side of it. We underwrite the property, but we also look on the property manager or his property management experience if he's not going to do it himself. So that's one thing. The second we're looking on is liquidity. So when we evaluate the loan to qualify it, we want to see, again, usually between 6 to 12 months of what we call PITIA payments in his account. So it's principal, tax, principal, interest,
Interest.
insurance, and HOA. So those are the ongoing costs that a property, let's say I own a property of $200,000 in Jacksonville, and my yearly taxes is 1,500, and my insurance is another $2,000 a year, and my principal mortgage that now I'm going to take is another $500.
You look at all fixed costs, basically.
Taking all the fixed costs, I want to see in their bank account in the US or outside at least between 6 to 12 months. Why do I do that? I want to make sure that this guy or this lady, they're not over leveraging themselves to the last dollar that they have. I want to see that they have some liquidity. So if God forbid something happened, a tenant is not paying, or you're just between tenants, they have enough liquidity to cover for 1-2 months if needed, and until the tenant will come back in, and then the rents goes back into the loan. So we look on their investment experience. We're looking on the market and the stability of the market, of course, and we're looking on the potential market rent. We're looking on the property managers, and we're looking to have some reserve to make sure that they're not over leveraging themselves. Basically, we help them to safeguard their own investments because.
But do you actually hold the, I mean, as a part of your covenants is that you have access to their bank accounts?
No, we don't hold the money, and we're not asking them to give us reports every month or something like that. It's called post-closing liquidity. So let's say we're going to close on May 1st. We want to see that by the end of April, they have X amount of money in their bank account. What happens after the closing, I can go and check, hey, did you use the money or not? Yeah, that's not how we work. Again, it's trying to create a picture that is this borrower and this property is something that I want to finance. Is the property in a good condition? Is the property in a good market? What will be the market trend? So if maybe this tenant is not going to pay, and he needs to replace a tenant, what the next payment will pay. So we're trying to understand the picture on the property, understand the picture on the investor. Is this someone that I want to lend money to because he's a stable investor? And if yes, we move forward.
I'll tell you, look, there's a lot of similarity to how we think, I believe, because you are looking to underwrite the right property and basically to underwrite the right property owner with less risk. We are pretty much in the same situation. Okay, on one hand, we don't want to manage any property that someone wants to give us to manage. Properties that you don't want to underwrite, we don't want to manage for the same reason.
Exactly.
And there's of course a lot to collaborate here to make sure that we are looking at the same people with the same lens and the same idea around who they are. Part of the lessons we learn that we don't want to manage every property out there. At a certain point, we did that. That's what I'm saying. But did you do those types of mistakes at the beginning, or did you improve that thing, or you were like solid from the get go?
For no, you always try and for example, our minimum property value used to be $80,000, and
80,000.
now it's $100,000. On some different on some properties or some different loan amounts, we need the loan amount needs to be over $100,000 if you want to get a higher leverage. So if you want a 75% leverage, I need the property to be worth around 150 because I want to see a more stable property to give you more leverage, for example. As we said, we're looking at the same. You want to make sure that the property as an investment will work. I want to make sure exactly the same. And I always say, if I say no to an investment property as a financing institution, it doesn't mean it's a bad investment. But what it does mean that it doesn't fit my risk profile. Maybe it's in a two property and stuff like that. But if I say yes to it, it's by definition says there's a very good chance that it's a good investment property because, like you do, we do all the background checks on the property, on the market, on everything related. And if we say yes, we're going to put the majority of the money. We put 75% of the purchase price. So most of the money in the deal is our money. We want to make sure that the deal is going to work because I don't want to.
It's a great point. I can tell you that the most challenging owners that we are coming across are people who attended all those seminars and the gurus we were speaking about before, and they were taught like put the minimum amount you can down, leverage yourself to the teeth, keep the leverage as much as higher as possible, refinance in the future and all that thing. But that what happens, they don't have any free cash flow to afford a plumber whenever something happens. They can't take any risk on themselves, and this is where problems start. We see them very slow in addressing the problems in the properties. We see them be very, very sensitive to the point of every dollar. Especially, it happens a lot with commercial loans, where well, the interest rates are not the same one for 30 years, and they're adjustable. I mean, that's like part of the reasons people have that notion of rules of thumb, various rules of thumb, how to evaluate the property quality and the future of the investment. And then those rules of thumb meet the reality.
Unfortunately, you're right, and the reality is not always as pretty as the Excel file. And if you look into our platform on the partner side or in the borrower, our IRR calculators has much more data points than a regular one. So it's not just what will be the rent, what will be the tax, what will be the insurance, but it's what will be the maintenance cost, what will be the vacancy, what will be other expenses that are related to the property. Let's try to think on everything. So when you look at the numbers, it's not a pretty Excel. It shows you the reality that as you expect. And again, sometimes you get surprised for the best. You can get a higher rent, or no repairs were needed for a year or so.
We
And
are
sometimes
open
for the
for good surprises.
exactly, but you want to under promise over perform. And related to what you said about people leveraging themselves too much, again, that's why we're asking for those 12 months liquidity. So in case something happened, and something happened as you mentioned, it's not the tenant is not paying. The tenant could be a good tenant and he's paying on time, but the bathroom just broke, and it happens. And now you need to spend $600 just to replace something. And again, you have a good tenant, you have a nice house, but things happen.
Look, yeah, with the current sort of interrupting with the current tariffs and with the current cost of work, of labor, and the cost of lumber and everything goes up. Today to replace an AC in Arizona and Phoenix would cost you like what? Almost $9,000. $9,000. Think from the perspective of a small investor doing that first time right now. That's like a couple years of free cash flow if he was lucky to generate cash flow at this point. So that's like a substantial thing. And this is where the reality is that people don't understand that they are actually investors. They are taking risk by definition, being an investor means I'm taking risks. The future is unknown. Markets can be volatile, but there might be issues. There might be an eviction, which might be an expensive cost. There might be a squatter coming in, and then to evict a squatter in certain areas, that becomes like a legal fee, a nightmare, and takes forever. And you have to have the stamina to service the loan, the mortgage, and to actually keep on running the rental business and not go belly up. So yeah, do you have like examples like that, like real stuff that you came across?
So luckily, most of our investors are solid, but we do see when we underwrite properties, we see everything that you can imagine. From sometimes they have liens on the property they haven't know, they have insurance that they forgot to pay and now it costs more, or they have all kinds of debts to the agent that they just forgot to pay and now the agent is charging them over. We see properties that they thought that maybe on a refinance because you see person own it for a year, 2 year, sometimes even more than that, and everything is okay. He think the property is amazing, and then we send the appraisal in to go and inspect the property and give us the value, and suddenly he sees that there's a leak in the basement. We say, okay, we will not finance the property until you fix the leak. Now fixing the leak, suddenly they have $2,000 cost that they were not expecting, because again, the property is rented, they're getting the rental. The tenant didn't even tell them that there's a leak, so because the tenant doesn't go to the basement, so he doesn't care. But when we want to finance it, we suddenly see a pool of water in the basement and say, hey guys, you have an issue. We cannot finance until you fix it. So now it's prolonged the process a bit. They fix it, and then we can close. So, the smarter investor, they understand, okay, we just, save them a lot of money. Because if they were not noticing this lien or this problem in the property, and they were just waiting until this pool will become, in their backyard, and then it's much more costly to expand. So part of the underwriting, and that's what I always say, we're doing a double check on the property. So whether you're buying it or whether you're refinancing it, it's someone external looking on the property, again, trying to understand, is this a good property to invest in and to finance? And we give you another set of eyes, very experienced set of eyes, using all of our database and all of the information, all the different third-party providers, to understand if it's a good deal or not. For example, I'll give you an example we just had on a deal we didn't do here in Florida. So the investor, super seasoned investor, American investor, holds a lot of properties. He came to me and said, hey, I've got an off-market deal, 28-unit building. I'm getting it directly. The owners are fighting among themselves, and I offer them, stop fighting. I'll just buy it out of your hands. We agreed on a price. I want to move forward. I told him, okay, send me all the information that you received. Even before you put a final offer, before you sign on everything, send us all the information. Again, the T12 and the rentals. Again, talking about a bit commercial, so it's slightly different. There's more data, more underwriting. We evaluated, we sent it to our underwriters. They did an initial check before we even issued a term sheet. And we found out that the property is in a flood zone, and he didn't know that. So the insurance is going to cost $20,000 more than what he thinks that it's going to cost. And the taxes are going to go up in this county. And whatever they told him in their report, that's not really the taxes that he's going to pay. So we get back to him and said, hey, we can still finance this property, but you were expecting to get almost 80% loan to value. We cannot do that. The reason we cannot do it is because the numbers don't work in 80%. If I'll give you an 80% loan, you're going to be under the water because your taxes are higher and your insurance costs will be higher. So we take a look around the information we get and say, you know what? You're right. I'm not doing this deal. Either they're lowering their price so the numbers will work again, or I'm backing out of the deal. And in this case, they didn't want to lower the price. So you back out of the deal. So we just saved him from doing a bad deal.
That's amazing. That's amazing. That's great. I mean, that's another reason why they should engage with like a data company like you guys to get that type of feedback and maybe realize things they couldn't realize by themselves with the realtor or whatever. Basically, everyone else is conflicted. They just want to sell. You want to not you don't want the default part because this is where
Exactly.
you lose. So you're like a balancing thing for them.
Exactly. We always say we're not in the history. There were some players in the industry that are predatory lenders, that they're lenders, but are actually real estate players. They want to get the real estate. They want you to be on a default so they can take your property discount and manage it. We're a finance company. We don't want it, and we don't know how to manage real estate. Maybe on the personal level, we know how to manage real estate, but not as a company
Not
level.
your business.
Exactly. If we get the property to be defaulted or the investor to default on the loan, it's our failure. and we do everything in our power to make sure that that won't happen. So we and the investor are 100% aligned. I'm not trying to sell him any dreams. I'm giving him, this is the truth. This is the reality as we see it. Maybe you think we're wrong. Maybe you think you can get a higher rent here, or maybe you think the property worth more than we think. But this is the reality as we see it. And based on this reality, we're ready to give you up to $300,000 of a loan against this property. You think you can get more? You think you were wrong? It's okay. It's yours. Take more money. Don't come back, to us later. Say, hey, I'm over leveraged and I lost the property because I can't uh, you know, pay my mortgage payments.
Yeah. Look, we spoke about that. Real estate investing is a long-term play. Eventually, it's an investment decision for people to generate a generational wealth or to have real estate as a store of value for years to come. And there are a lot of different aspects. It's not just buying the deal with a good deal, buying it cheaper, $20,000 or $40,000 cheaper than whatever. It's actually getting not just the deal done, but actually running that as a rental business mindset to make sure that that rental unit as a business actually appreciates, actually makes the numbers. And of course, we as real estate investors can serve the debt and we can serve all the costs that are needed. And this is where we see quite a bit of, as property managers, we're seeing a lot of horror stories coming in. And part of our, I would say, uniqueness of our product was to understand that this is a very volatile world, okay? And people are actually having problems predicting the future. Some of them don't think of the rental property as a rental business that they need to run as if it's a restaurant or as if it is any other type of business, but it's a business. There are renters who are coming in, paying you a subscription fee every month, like for the experience that they are buying of raising their family in your property, and they're willing to pay for that. And if you are not able to keep that property in a good condition, address those issues, and there are a lot of things piling up, you are basically putting your entire business in jeopardy. So we came up with this plan where we are making more predictable for people by crunching all that data and selling kind of profit protection, call it, product where people can be much more passive by paying that. So we're basically not selling property management in a way, but
That's a,
trying to sell a profit protection plan. And this is where we live in synergy because that's exactly what you want. You want the profit to be as predictable as possible so they could serve the loan and then take another one and build more wealth, right?
exactly.
But then the reality hits. Then the reality hits, and we are seeing quite a lot of issues, which I mentioned, with evictions, with squatters, with inability to service the ongoing business. And this is where I'm thinking, where's the gap sometimes come from with certain property owners? Is it because they didn't think that this property is risky? It's like with stocks. Think about it. You can go with like a risky stocks and then maybe have a higher yield, or you can go with like super solid ETFs, have lower yield, but more secure. Where are you on that scale of risk versus less risk? Okay. And sometimes people are looking at this metrics not from the risk perspective. And this is where you ground them to reality. This is what I like about this thing.
100%. And as you said, it's everything in investments related to risk, and everything. And we see it on the credit side. It's very much risk reward. You want to get a higher loan amount, so you want to get a higher loan to value. Basically, it means it's more risky for me. It's more risky. I will need to get me and my capital market investor will need to get higher returns. So goes with the problem. As you said, you want to on at least on the paper a double-digit return, and when you buy $100,000 property, maybe you'll get it. Maybe also, as you said, maybe you have evictions, maybe you have a lot of other things, and there's a good potential, but there's also a good potential of not making this money and getting stuck with the property. If you buy $300 $500,000 property in a better neighborhood, yes, it's not linear. So $100,000 property can be rented for $1,000. $1 million property usually is not rented for $10,000. It's not a linear line, but $1 million property will probably, as you said, they pay $7,000, so their income has to be more high, more stable or more high. It doesn't mean it's stable. So you'll probably have a better tenant to watch the house because again, they want to build their family in this house and work, maybe live there for a longer time. One thing that we do see now in the market, it's interesting to hear from your side. I'm hearing from a lot of investors that their tenants are asking for 2 years term, not just a 1 year term, because they want the stability. And it's, I don't know if you see it on your markets, but a lot of people say, I'm not, don't raise the rent next year, but let's do a 2 year rent. And that's part of the things that I think as owners, that creates stability. Because, okay, you know what? I'm not going to bump the rate in another 5% next year, but I know I'm not going to have vacancy. So this 24 months in a row worth more than 12 months, and then a month or two for vacancy, and then another 12 months.
And that's what people, some of them are who are not approaching this entire thing from an investment standpoint, but more emotional standpoint. They are not aware that 1 month of vacancy is like 8% of your annual revenue. 2 months, like 16% of your annual revenue. Spread it across 24 months, and it's like percent lower. I mean, the math should work for everyone. And yeah, I 100% agree with you. Stability is a key here in real estate investing. We see some smart investors who are actually giving up on raising rents, even if they can, just for the sake of stability, of having the tenant there as long as possible, because vacancy, turnover,
Repair.
leasing fees, finding a new tenant in a shifting market might take time. And we are seeing quite a few markets, by the way, I'm interested in your perspective, where there's a lot of new construction happening, and we actually see in those markets rents are going down. Not like bulletproof going up every year by year. Something is changing. Do you share the same?
We see it from the market rent, but we also see it from the property values and the
Okay.
time on the market. So if you look on the west coast of Florida, not the Miami area, the Punta Gorda and Coral Gables and all those are Lehigh Acres, we see there was a lack of houses there. Throughout COVID, a lot of people understand that people are moving to Florida and they need more houses. So there were thousands of projects starting, and now those projects are completing. So you have thousands of homes, all new construction, all in great, great locations to the area, are going to the market at the same time. And there's not enough people to rent them at the same time. So unless you have, a very unique house, which most people don't, it's just a regular single family, so either if they want to sell it, you will not sell it at the same price that you wanted because you thought COVID is just going to keep on rising and market has shifted, and now in those places, 5 to 8% decrease in prices. Also, rents are going down because if I'm a tenant and I have 50 houses in the neighborhood that I want to rent and they're all vacant, so I have more leverage on my side. Eventually, it's a cycle. More jobs will be created in the west coast of Florida. More people will move there. Some of them actually already moving from our side of Florida, the Miami area, which became too expensive for a lot of people. So they're looking for an alternative, more affordable alternative, and the west coast of Florida supplies that. So eventually, in a year, 2 years, 3 years, 5 years from now, it will stabilize. But as you said, that's a long-term play. You need to understand as an investor, I cannot time the market. It's very hard to time the market on
Stocks.
stocks. It's the same with real estate. You start a construction project, you know where you start, you don't really know where you're going to end. And if you don't have enough buffers in your plan, sometimes people don't, then you need to understand you're taking some risk. And maybe we see some projects now in the West Coast that people completed more of a higher end on the West Coast, $1 million properties that they started, they built it. Now when they put it on the market, there's no such a big market for $1 million property in the West Coast of Florida. So they came to us and said, you know what? We're going to hold the property, give us a 30-year loan instead of the construction loan. Even if we're going to be under the water, we're going to, it will cost us $10,000 a year out of pocket. But we believe, that's what they say to us, that in 3-4 years from now, the market will stabilize again. Even if I paid, let's say, $10,000 a year. So I paid $30,000 out of pocket, but my potential revenue will be more than that. So that's one thing. And another thing that, again, connecting to what you said before, real estate is a business and it needs to be run like a business. And when
Like
you
a
look,
business.
so one of the things that a lot of people are missing, and it's one of the amazing tools that the US market has to offer, is tax deductions. So when you're looking at say, but my mortgage is 7.5% or 8%, it's super expensive. So wait a minute. The mortgage is another tax deductible cost, same as fixing the sink and same as your property management. Don't look on the top line. look on the bottom line, because at the end of the year, you need to file your taxes in the US or in your country of origin. If you're a foreign national, so you file in both places. And then they will ask you, what did you pay? And all those expenses around closing a loan, financing it on the ongoing market, fixing the property anytime that you have a fix, those are actual deductible expenses. So instead of paying more taxes, you're paying less taxes, so you keep more of your income to yourself. So again, it's the same as you run a store. You're not looking just on your top line income. I sold a shirt for $10. Exactly. You're looking on the EBITDA. You're looking on the real earnings, and the same needs to be done with real estate.
You mentioned taxes. With internationals, it's like a big deal right now. Like that's the vast majority of your clients. You said 70% are international. Like, do you look at taxation plans or environment in each and every state?
So the plan that the current administration is taking with the tariffs is basically on trade between countries. It's not taxation on money between countries. And remember, the real estate is not going outside of the US. The real estate is still in Florida. Maybe a hurricane will take it to the Bahamas, but if there's no hurricane, it stays here in Florida. So the money coming in as Canadian dollar being converted into US dollar, and when it goes back, it goes as US dollar converted to Canadian dollars, but there's no trade. It's investment into the US market. So the tariffs are not directly affecting that. Where the tariff can infect. So again, if we took the Canadian example, so the tariffs with Canada, because Canada, 75% of its GDP coming from the US, so higher tariffs from the US can really impact the Canadian economy, which create a higher inflation rate in Canada. And the inflation rate will be higher in Canada than it will be in the US, because again, the US is not trusting the Canadian economy so much because it has other income-based sources. So if I'm a Canadian and I make my money in Canada, I'm a lawyer in Canada, okay? I'm making my money 500 Canadian dollars per hour and I'm selling my time in Canada. My Canadian dollars, if there will be an inflation, will buy me less in Canada. And if I need to, and if the US dollar will be stronger than the Canadian dollar,
Or into the United States market.
it will be even harder to buy. So using financing into the US, you basically use less of your Canadian dollars, exchange 70% less, because you can 70% or 75% here in the US side as financing, and you get it based on US dollars because the loan is in US dollars. The rent is charged in US dollars, and you pay the mortgage and the tax and insurance in US dollars. So basically taking financing in the US, lowering the currency exchange risk in 70% or 75%, depends on how much financing you're taking. Just to answer your question, so one, the tariff does not directly affect real estate. They affect other industry that by the ripple effect of that can be inflation, can be harder to do business in the US or with the US, but it's not directly affect real estate. And financing with US mortgage for investors overseas limit this exposure to currency exchanges.
Got it. Makes perfect sense. Look, we are kind of getting towards the end. I wanted to maybe get a little bit more personal, if you are okay. Feel free.
Shoot.
What prevents your sleep those days? I mean,
Uh,
business wise and maybe not, whatever.
Other than my three kids, that's always prevent my sleep, but that's for good reasons. But like any industry, and we're connected to a lot of industries. So we're connected to the real estate industry because we finance real estate properties. We're connected to the capital markets and the stock market because after we originate the loan, we sell it in the secondary market and it goes to securitization or it's sold, as asset-backed securities.
Mm.
So we're connected to that market, and we're a tech company. So we're also connected to the tech environment and to the tech industry.
And to the VC landscape and ability to raise money and all that.
So every one of those industries is part of our day-to-day life. The VC industry, the capital markets, and the real estate. Instability in the markets affects us all. Like any other business, we need clarity to understand what's going on. So basically, the main thing that I'm thinking about at night is what will see the market tomorrow, what will change, what will stay the same, and trying to say, do I need to do something in my business to meet the next cycle in the right time? What kind of infrastructure do we need to put in place right now to be more ready when the next cycle comes? And it's a when, it's not if. Everybody knows real estate is a cyclist industry. The next cycle will come in 3 months, 6 months, 1 year, 2 years, but it will come. And everything that we're thinking is, okay, I don't know when it's going to come, but I want to know what I need to have in place when it comes so I can enjoy giving liquidity to people that need liquidity when a market is shifting and they can find good deals and they can find good investments. So we always try to think, predict where the market is going and think what we need to put in place today to be ready for the day that the market will change.
So maybe walk me through like your prediction of the market, let's say year forward. Like what do you think is going to happen?
So
You
I
see, you
don't.
see the interest rates. Everyone is thinking about lowering the interest rates and all that thing. Like, what's your kind of understanding of the universe?
So one of the big problems that we see in the industry in the last 6 months or more even, and now we're almost a year, is that none of the traditional models in the financial industry are not really working anymore since
What do you
COVID.
mean? Yeah.
So, for example, if we're taking the interest rate, you took the interest rate as an example, then one of the main factors on real estate in the mortgage industry is the 10-year treasury bond rate. Okay? So, usually, historically, when the Fed lowers its interest rate, then the treasury goes down, then the mortgage payment goes down. So, the mortgage rate goes down. And the Fed started, lowering down the rates, and we saw it in September 2024, sorry. The rates went very low comparably, after 2 years of craziness. I went to around 6%. And the Fed says, I'm going to continue decreasing the interest rate, or at max, I'm going to keep it the same level. But suddenly, for the first time, we saw that the US Treasury is starting to detach from the Fed rate. So the Fed rates remain lower, and they said, we're going to lower it again. But suddenly, the US Treasury went up through the roof. Mortgage rates went into the sevens suddenly again, and stayed there since then. And that's the first.
Government prints money. That's what you mean, like basically prints money to.
It's not just the printing of money; it's more the trust of the market in the economy, than the U.S. economy and the U.S. government. Because basically, what is a U.S. Treasury bond rate? It's basically, if I'm managing $1 trillion worth of asset management, I said I need to put my money somewhere. What is the most secure product that I can do? The most secure is the American bond, AAA US securities. So everything that I will invest or consider to invest, I will say, okay, how much of a margin on top of the US Treasury I can get to do, to take my money into real estate asset-backed securities or to mortgages. Okay. So when the US goes down, the US Treasury goes down, say, okay, I'm getting 3% on US Treasury. I can do 4.5% for a mortgage, or 5%. But when I'm getting 4.5% on a US Treasury, I need 6.5 or 7 for the mortgage, because I need the margin. Because otherwise, I'll buy US Treasuries.
Right.
And why does the US Treasuries is remaining high? Is because people are not certain in the industry and in the markets that the US economy will basically be as strong as it could be, because of macroeconomics and government changes and a million and one things. And then they say, okay, so I want more money to buy US Treasuries. And the US government need to do that, because, again, they need the debt to continue operate the government. So all those different forces playing in the same market created a lot of changes and make it much harder to predict. Do I still think the mortgage rates will go down and the US Treasury will go down? Yes. Do I know if it will be in 3 days or in 3 years? Actually, no. Because if you were looking on the market 2 weeks ago, when Trump announced the tariffs at the beginning of April, in one day, a lot of money went out of the bond market, and
So the yield spiked up.
And the yield went down, because people said, you know what, I'm losing all my money in the stock market, so I'm moving my money to US Treasury. So if everybody buy it, it lowers down, because now the US can say, you know what, I'm going to pay you less because everybody want to buy it.
But there was also a spike up, a crazy spike up.
24 hours later, or 48 hours later.
Okay, yeah.
The president saw the effect in the market and said, you know what, I'm pausing. I'm giving a 90-day pause to see what's going on.
Everything spikes.
Everything spikes, everything go back again. So you see this volatility. Volatility is not good for the markets. Again, some people will make money out of this volatility, because somebody always makes money, but some people will lose money. And in general, when looking into the industry, a lot of people are just sitting on the side and saying, I'm not sure what to do, because if my plan as of today's, based on today's numbers, I'm not sure what happened. What did we? And just to finish on that point,
sure.
We see the people that continue by are the ones that have more experience. They've been here for a longer time. They've seen the market going up and down, and they take more buffers. So they say, you know what? I'm not sure what's going to happen in the market. So I'm taking another 10-15% buffer in my business plan. So the worst case scenario, I'm still making money. But I'll be the one still buying when everybody stops buying, and then I get the better deals than everybody else. So again, smart.
Basically, would be your advice to someone who is looking right now at the U.S. real estate market? Like, what would be your top advice to those people?
Look on the numbers. As of today's market, we still have a relatively high property value and a relatively high mortgage rate. If the numbers work in today's environment, most likely it will continue to work in a different environment. So look on the numbers, don't buy from emotion, and add into any plan that you're making, add another 10-15% buffer. Do the stress test to your investment, see if it works with a stress test. So maybe you won't need it and you'll just be happy surprised. But even if something bad happened, if you buy correctly and the numbers work today, they will most likely work in the longer run.
And then go to your website, try the new IRR calculator.
They're always welcome to a website. They're always welcome to run the pricing with us. Ask for a term sheet. We evaluate the deal based on the information we have. Give them the real numbers as we see it based on their information, and then take a smarter decision.
Where do you see the VC world going?
This is I think a lot of the VCs now, everybody using the AI hype word. A lot of VCs.
You came up with the AI before it became a hype.
Exactly. Lendai was before the hype and before the
Before
LLM.
the hype, like 6-7 years ago, you say.
Exactly. And we
Yeah.
use it to evaluate better property value and property income and IRRs.
Right.
The AI in general going to change a lot of industry. It's already today changing the ability of people to start companies and build products with much smaller teams with much less money. So there will be a change that people maybe don't need the VC in some places. And say, you know what, I'm going to take your money just later on the process, which is a good and bad thing. Maybe it's a bad thing. Maybe the VC cannot come in a very low value and start pre-seed in a very low value. But on the flip side, for the VC investors, there are also the chances of actually winning and getting this company to actually do a 5x, 10x, and not closing in a few years are lower, because if they come more prepared to the VC, because they already managed to, they're more mature, so the risk goes lower. So again, like everything we said, everything in life is risk reward related in investment.
I don't envy the VC world today. I tell you why. I mean, so many solutions, AI is coming and injecting its value all over the place. How do you choose the right company that will not be disrupted in 3 months, not 3 years, 3 months? So many companies are now building everything, and this notion of three people unicorn company, I'm not sure I'm a great believer in this one, but still, it's not a simple thing. As part of that ecosystem are affected by this world as well. I mean, need to navigate it.
But again, if again, I'm not a VC and I'm not actively investing in startups at the moment, but I want to look at things that are bulletproof for those kind of things. So let's say even take property management. Well, property management will be different with more and more AI agents and AI processes. Yes, but do I eliminate the property manager at all? No, there's still a property. There's still someone, and no AI can go and fix. There's no AI plumber yet, right? And it will take maybe 100 years until we have an AI plumber. So those things will still be there. So maybe it will be a more efficient company that will order it more and do the follow-ups faster. But the core of the industry is still there. People will still need money to buy houses because they still need houses to live in and to rent. So the traditional industry can be improved by AI, but the core will not be replaced. They still need the financing to buy the house. Maybe they don't want to wait 30 days, they want to wait 30 hours to get a financing, but they still need financing. So whoever will solve and make the same product, the property management, the financing, the sourcing of the deal smarter, faster, those will be the ones that will take a bigger chunk of the market. But the core industry will stay there.
Maybe last question to you. If I'm like a high wealth individual right now, living elsewhere in the world, and I have money, and maybe not enough to buy all cash in the real estate now, but maybe I want to buy a couple of properties with whatever I have, and I'm debating, should I just passively invest in S&P 500, or should I go for real estate? I'm hearing this question quite a bit. I mean, there are a lot of pros and cons. If I know it's a big question, but maybe you can give like your perspective on this thing, like why real estate is still a great thing to do.
So I think the answer is, and it depends on how much money you have. But the more money you have, you want more diversification. So if you have $1 billion to invest, you'll put some in S&P, you'll put some in startups, you'll put some in real estate, and while saying real estate, it's not the same as saying real estate versus stocks. Real estate by itself,
It's a
it's a,
huge.
it's an entire world. They have residential and commercial and multifamilies. Within residential, you can buy and fix and flip, or you can buy and rent it short-term rental, or you can rent it long-term rental, or mid-term. Now they have mid-term rentals as well. It's a mix of a lot of things. Eventually, the main advantages I see it with real estate towards stocks is that, again, if you buy correctly, the chances that you will lose the the principal amount that you invested, you've put $100,000 into a property, the chances that you will lose those $100,000 are very, very slim. Maybe some years you won't get the 10% that you want. You get 5%, you get 3%. They'll be flat out one year. But your base money that you put into the equity, either it's going to grow, because that's what it happens if you buy. But even if it didn't grow for a year, something happened in the market. You're not going to lose the base equity again if you buy correctly. With the stock market, as we see in some people, unfortunately, in the last month, some people bought something and the next day it was worth zero. And we saw some good companies today in the market that had amazing ideas, and they were lacking on the execution, or the market have changed on them. And you bought it at $1 billion, and now it's a $10 million company. It doesn't have, if you buy $1 billion real estate, and again, if you buy it correctly, it won't go to $10 million real estate. Maybe it will not go up to $1.5 billion, but it will probably stay. So the core asset is more stable because people need houses to live in. As you said, the clients, they buy the SaaS. The SaaS is, I need somewhere a roof and 4 walls. They still need it. So that will not change, and that's, I think, the main core. What do I recommend to the high-net individual? I recommend do a bit of both. Put some of your money here, some of your money here, some of your money here. Play with different strategies, because for the long run, something will work better than the other, but you don't know it today.
Yeah, and still, I mean, the U.S. real estate market is the largest, I think, asset class out of all the other asset classes. Like, I don't know, I think by X at least, like from the bonds versus the global real estate. And it still has a lot of nuances, as you said. Different types of real estate, different types of strategies, SFRs, multifamilies, commercials, storage, just name it. There's so much to do in real estate. And the benefits, of course, are the leverage and the tax deductions. And eventually, it's something solid that you can actually see and touch, and it has its value to it. So I do believe that you are right. It's not a competition. It's a diversification strategy between different asset classes, and the right and smart investor understands the risks of all the asset classes and knows how to do the business plan for that type of business.
Or if he doesn't know, so find the right partners that they know and you can trust them.
Right, right. It was a great pleasure talking to you. I'm always happy to meet you. Thank you so much for sharing your knowledge and insights. And definitely, I recommend everyone, you guys, if you are looking for financing solutions, Yair is your guy. Super personable, great company, good friend of mine, does a lot of good to people and the universe, in my view. That's for private things. And thanks so much for being on our podcast.
Likewise, and thank you very much. We're always happy to join and join forces with Home 365. I love to see the way that you guys changing the industry, and let's just wait for the next cycle and continue growth.
Of course, we'll be there. Thanks so much.
Have a good